Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB on this Monday afternoon. It is really nice to be here with you. As always, I'm Nadine Blaney, and look, we're going to wrap this session. It's been an interesting one. And when we bring this market picture up, I mean, yes, we are negative to the tune of 0.6%, as you can see there for the COB Australia index. Of course, we still have the last of the day's trades going through the ASX, but really bounced off the lows that we hit shortly after 11 o'clock. So look, it could have been worse. And, you know, sometimes it sounds a bit flippant to put that spin on things, but you know, the S&P ASX 200 at 8,451, a loss closer to 0.8%. Obviously, we're still keeping a very wary eye on what's going on in terms of the Middle East. We've had a mixed sort of picture coming through the Asian session. U.S. futures have improved as this day has gone on, so that might be why we're seeing a little bit less selling happening here locally. But of course, it's all about oil. It's all about inflation being brought in from oil. We've seen prices continue to rise in the Asian session after Yemeni Houthis attacked Israel. We've heard that the U.S. will allow Russian oil tankers to reach Cuba, so that's sort of separate from the Middle East conflict. And Albanese, the Prime Minister, is calling for more certainty on U.S. objectives. And Donald Trump, the U.S. President, wants the U.S., we're told, to take, quote, Iran's oil. So we're trying to deal with the impact of our dwindling fuel reserves here in Australia. And National Cabinet has agreed to have the fuel excise for the next 3 months. At current levels, this means 26.3 cents off a litre of petrol. Prime Minister and Premiers also agreed to drop the heavy vehicle road user charge to zero until July. These measures will cost around $2.55 billion over the next 3 months, with no details on the Treasurer as to how this loss will be offset. Having the fuel excise cost is part of Phase 2 of the National Cabinet Fuel Security Plan. Phase 3 includes more targeted actions, but it will need approval from a new National Cabinet meeting. Viva Energy rose off the back of that news, Ampol up as well. So having the fuel excise tax for the next 3 months, but look, I think that there will be some, pressure being borne on these companies not to gouge consumers either. So that sort of sets us up for our 3 themes of the day, which of course is servo support coming through, that bounce, a relative bounce that we did see for the local market, and the fact that we've got sector-wise 7 out of the 11 sectors lower, but materials and energy really mitigating some of the losses. And you can see there, Karoon, very much a play on the oil price, up by 6%, Woodside as well. And we've had a couple of broker notes come out talking up coal. If we don't have fuel and gas, that it could lead to more coal being burnt as well. Okay, here's some of the big resources names. Iron ore was relatively steady. I mean, actually a little bit mildly positive. Rio Tinto's up by close to 5%, PLS South 32, and Northern Star is up by 5%. Lynas coming off the boil a bit, down by 2%. Taking a look at the financials as a sector, down by 3%, more pronounced selling for the likes of Westpac. And let's get across some of the corporate stories away from that. And we've got AMP lifting. Citi is supporting the share buyback plan. We've got Webjet's Managing Director and Chief Executive Katrina Berry resigning. It was the stock of the day. I'll bring you analysis in just a tick. Drone Shield is opening a European headquarters in Amsterdam. We spoke with Drone Shield. We'll get that up online for you shortly. Star Entertainment is working to complete its refinancing by the middle of May. Got a bit of a lifeline from private equity. And Navigator Global sealing a partnership with Georgian, which is an AI-focused investment firm. Shares up just marginally. Let's, though, try to make sense of it all, and to help us do so, welcome to the COB. Here with me in studio, Josh Barker from Barker Wealth. Joshua, how are you?
Good to be here. Yeah, great.
Great. And look, I don't want to, just have my rose-colored glasses on, but it could have been worse today.
Yeah, definitely. This morning's open was very sharp, but it seems like the 10% from the highs is kind of a significant buying level for some anyway. But yeah, how long it holds, I think we're going to have to just basically take a lead from Wall Street this week anyway.
Oh, of course, yeah, and the headlines, of course, around the Middle East. It was interesting. I read a report today saying that we're not yet in the hold your nose and buy small cap territory. Would you agree?
No, definitely. I think it's really how long's a piece of string as to how bad this could get, and I don't think you need to be rushed per se, because we've got the market off, let's call it 10% from its highs. If there is a treaty or a truce, or however this end looks, it's hard to even imagine right now, but the market's not just going to immediately go up 10%. So you'll have plenty of time. You'll have plenty of time to sort of build out your watch list, allocate, to areas that are probably going to fare a little bit better. Financials, whilst they're off quite hard today, they're touted as sort of being a somewhat beneficiary from the higher rates environment. But yeah, I think there's going to be a lot of pain, particularly in sort of the consumer areas. Subsidies and things like that sort of help your everyday spender, but they don't really fix the overarching economic, sort of pain that this causes. A lot of the flow on will occur in the inflation prices. Fertilizer goes a lot through that area. I'm hearing that's already up 50 to 70% in the last month.
Yeah, I spoke with the CEO of Cotton Australia today, who said that it's actually urea, which of course is used in fertilizer, that is his bigger concern, more so even than diesel at this point.
Yeah, exactly. So like if they can't get that, then that's going to jack up the food prices even more. And then you just got the little things like building costs have already started to go up this month in terms of the raw materials that are coming through. So that's an issue that we had coming out of COVID. It was just starting to sort of settle down, and then lo and behold, we've got another lot of issues, which flows on to our housing crisis that we've got here. So there's a lot of cracks in the economy that this particular issue in a different country really exposes, and band-aid solutions I don't think are going to fix it.
Yeah, and we've got some calls for GDP to go backwards. We're still talking about interest rate hikes now, not just here, but interest rate cuts have been priced out in the US as well. Yeah, it was Paul Bloxham, chief economist of HSBC here in Australia, expecting to see a contraction for GDP in the second quarter. So this also speaks to demand destruction, this whole situation in the Middle East. So where or what sectors do you think will prove to be more resilient? I know you mentioned the banks, given the interest rate environment, but what about resources, commodities?
Yeah, resources seem to be kind of doing their own thing at the moment, although we have seen some pretty dramatic drops, particularly gold. Look at Northern Star, you sort of your market leader. That's nearly halved in value in the last month, which is quite significant for such a big company like that. And we're starting to see some really concerning signs globally. Big markets like the Japanese market, for example, down 4 or 5% in a single session. Some movements similar to that, obviously copper, pricing in a lot of that global economic slowdown. So yeah, we're starting to see some really concerning signs. So I think anything that's really linked to those interest rates is going to suffer. So your commercial property is going to come under pressure again. It's been pretty lackluster for the last 5 years, but it was just starting to see some green shoots, and that's going to probably go into another glut phase. Your consumer and discretionary stocks is probably an obvious one. But there will be areas. Healthcare's been really beaten up over the past couple of years, kind of on its own trajectory. But it's an area that really shouldn't be linked too much to the price of oil. Even indirectly, it's just not. It's not consumer related. Their clients are hospitals and well-funded clients. So yeah, I really do think that area is probably a flight to safety almost. But again, you're really struggling to get any yield out of that sector in particular. So, you can probably start to look at the banks for a little bit of yield, your big iron ore plays, and then anything investment-wise just related to the RBA cash rate as a premium to that, you can always look to as well.
I'm wondering, have stocks, just given what you said about healthcare, medtech, have stocks, that were previously market darlings still on very high PE ratios? Take Pro Medicus, for example. Like, is that the kind of opportunity you think you still don't have to rush into?
Oh, it's very difficult to price that one. Still trading, I think, 37 times earnings, which is high, but it's, previously it was double that. So everyone said they'd buy it when it comes off a little bit. It's come off a lot, and I think the buyers will start to come in eventually. It's one of those ones where time frame's important, allocation is important as well. So that one would be, as we call it on the call, a nibble. Just a really small allocation. Tuck it away in the bottom drawer for 3 to 5 years. Keep an eye on the fundamentals. Don't blindly buy it, of course, but right now the fundamentals are strong. They've been picking up market contracts still. The revenues and everything are growing. You don't expect this to be any correlation. There was an interview with the CEO where he said, we had a rate hike. Does that affect you? The answer's no. So, the fundamentals of that business are really going to be quite resilient. The PE is going to come into question, but if you're comfortable with the business, then you can sort of ride out those PE fluctuations anyway.
Would you be getting any of your clients into anything retail oriented right now, consumer facing? No,
definitely not. I think that's probably an area that's going to struggle the most. We're not in a recession now. Even that expectation of a contraction for one quarter, that's not even a recession. So we could go into a pretty deep, dark recession here in Australia for 3-4 quarters potentially. So that's where then those discretionary stocks are definitely going to be hurt the most.
Yeah, Westpac is calling for a further 3 interest rate hikes coming through. Not great news for anybody who's got a mortgage. Oh boy. It is a tricky time, to say the least. Do you feel, that we're sort of, do you have any sort of COVID-y feel about any of this stuff? Or,
Yeah, a little bit about the sort of flow-on effect from COVID. So, we sort of had it's a very similar situation where, like right out of COVID, not during the midst of it, but we had this inflation come in from sort of interest rates coming down. Then that was exacerbated by the Russia-Ukraine war. Oil prices did the exact same thing. We saw all of the energy prices shift up, and then that flowed on. And it took 2.5 years maybe for that really to go away. It does, history doesn't repeat itself, but it rhymes.
Certainly echoes, yeah. All right, Josh Barker, thank you so much for getting us across the day and where you're looking in the market. Appreciate your time.
Thanks for having me.
From Barker Wealth. All right, stock of the day was Webjet. So let's take a listen to what my guests had to say, that being Adam Dawes from Shawn Partners and David Lane from Ord Minnett.
They did say that they remain, the demand remains quite resilient in what's happening, and they did reaffirm their 2026 guidance. Obviously, 2 key people, David Galt and Katrina Barry, moving away. It does say that there's some issues inside of Webjet that potentially, it's like the cockroach theory, yeah? You see one cockroach, there's plenty more underneath, and this is probably a good indication of that one. For me, I think you need for the war to fix itself before you look at these travel stocks.
We did have both Hello World and BGH bidding for the business. BGH had a bid at 91 cents, Hello World at 90 cents. Both of those discussions fell over, which is why you see the share price dropping significantly in January. Interestingly, in Feb, they came up with an announcement and they actually downgraded their earnings guidance. So although today's announcement reaffirmed their guidance, it was actually a downgrade that we saw in Feb.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, let's take a look at some of the leaders and laggards on this Monday afternoon. And Greatland Gold, it did really well today. It has upgraded one of the resources at a project, and I'm just trying to get the name of the project. Just bear with me for 1 second. Telfer. So it's got exciting high-grade additions there at Telfer. I don't have my glasses on. This is very difficult. Macquarie has lifted its price target on Greatland Gold by 2% to $13.50 per share, upgrading the company to outperform from neutral in the wake of that announcement. South 32 as well is amongst one of the best performers. It saw its target price lifted 12% to $5.60 per share by Macquarie. I'm not seeing anything associated with Alcoa, but making some good gains there. And then we've got that coal story that I alluded to earlier being brought about by the fact that we've got, big questions over energy supply. New Hope's price target has been lifted 46% to $7 per share by Macquarie, upgraded to outperform. So lots of broker moves coming through in that space from Macquarie. All right, now let's take a look at those that did drag on the market the most in percentage terms. Judo Bank, it's not been doing very well at all, off by 6%. Look, we've got the price target being cut by 14% to $1.90 by Morgan Stanley. So look, it's saying that the probability of loan growth is slowing and the losses likely rising due to a weak Australian economy. Although Morgan Stanley is slightly more positive, it estimates just a 30% chance of the bear scenario, albeit up from 10% previously for Judo Bank. Block is down 6%, Zip off, Life 360, that was covered on the call today. If you'd like to have a listen, is it in buy territory? You'll have to watch or listen to the episode to find out. And Temple & Webster, so I think that you can notice a theme there. Those are those high growth companies that the going gets a lot tougher for them when there's not a lot of money around and when money costs more. In the small to medium space, you can see that Beetaloo is up by 15%, the Omega Oil and Gas up by 22%, Tamboran. So all of these energy related companies, Calix as well, up by close to 13% to 60 cents per share. And those that really did way again, Loomis Diagnostics down by 12%, some in the gold space, and EBR Systems down to 58 cents per share. So we will be hearing from Fed Chair Powell, but it is a discussion at Harvard University. Still, any of his comments will be parsed for any hint as to where interest rates may or may not head, depending on how long this war drags out. Tomorrow, here we get RBA meeting minutes, which again will be really interesting to see how the Hawks really won. And we'll be having New Hope trading ex-dividend along with Maz Group, which is moving in, as you know, to the data center space in a very, very, very meaningful way. Here we go. Let's do this. We've got the S&P ASX 200 at 8,461, down by 0.6, almost 0.7%. Crude still rising, Brent and light crude, making big gains in the Asian session. We've got gold, though, just mildly negative. E-minis in the US, S&P 500 and NASDAQ both just now, just since the beginning of the COB, ticking into positive territory. I'm just, of course, checking to see if there has been any news on that front that might have inspired that move. And we're hearing that the US President Donald Trump has said that the US and Iran have been meeting, quote, directly and indirectly, and that Iran's new leaders have been, quote, very reasonable. That's as more U.S. troops arrive in the region, and Tehran warned that it will not accept humiliation. So Trump saying that he wants Iran's oil and could seize Karg Island. That's according to reports in the FT. So look, the market will swing will move based on any of these headlines that come out around the Middle East and any hints of positivity contained therein. But there are still very big concerns coming through from the Middle East. And we were looking at Alcoa, one of the best performers, and I'm just seeing a headline, aluminium prices, it makes sense. They've jumped because market participants bracing for a deeper supply shock after Iranian strikes over the weekend damaged two of the biggest producers of the metal in the Middle East. I was unaware we had aluminium production in the Middle East. So you do learn something new every day. And I can guarantee you may learn something new. That didn't work. I can guarantee you will learn something new if you catch up with any of the interviews that we did throughout the day. You can do so throughout the evening into tomorrow online at ausbiz.com.au, and we look forward to seeing you. We're live from 9:45 on Tuesday.